Welcome back, Navigators. In today's video, we'll see how to spot bullish or bearish trends before the crowd does using sentiment indicators that signal upcoming shifts in the market. Picture this, a bustling marketplace, traders shouting, prices fluctuating wildly, chaos, maybe? Opportunity? Absolutely. The stock market is a living, breathing entity full of energy and unpredictability. For years, I scoffed at the idea of predicting the market. It seemed like a fool's errand, a game for the overly confident or the hopelessly naive. It's a mug's game, I declare, smug in my skepticism. I was convinced that no one could truly predict the market's next move. Then I discovered something fascinating: investor sentiment. This was a game changer, a revelation that opened my eyes to a new way of thinking. You see, markets aren't driven solely by cold, hard data. Numbers and charts tell only part of the story. Human emotions, fear, greed, hope play a pivotal role. These emotions can drive market trends just as much as financial reports. Once I understood this, the game changed. It was like unlocking a secret code that had been hidden in plain sight. I realized that by tapping into the collective mood of the market, I could anticipate trends and make smarter decisions. It wasn't just about numbers anymore, it was about understanding people. It's a bit like reading a room full of people. You pick up on subtle cues, the unspoken signals that reveal true intentions. You observe their body language, their expressions, their tone of voice. Are they excited, apprehensive? These clues can be incredibly telling. The same principles apply to the market. By tuning into these emotional undercurrents, you can gain a deeper understanding of market dynamics. By deciphering investor sentiment, we gain valuable insights into where the market might be heading. Intrigued? Read on! There's a whole world of market psychology waiting to be explored. So, what exactly are investor sentiment indicators? These are tools and metrics used to gauge the overall mood of investors in the market. In essence, they're measures of how optimistic or pessimistic investors are about the market. They help us understand whether the general feeling is one of confidence or caution. Think of it like a gauge, indicating whether the mood is bullish, optimistic, or bearish, pessimistic. This gauge can swing back and forth based on various factors. These indicators come in various forms: the volatility index, VIX, advanced decline line, AAII, investor sentiment survey, CBOE Put, call ratio, CNN fear and greed index, the net new highs, and even social media chatter. Each of these sources provides unique insights into what investors are thinking and feeling. Each provides a glimpse into the collective psyche of investors. By analyzing these indicators, we can get a sense of the market's emotional state. Why does this matter? Because market sentiment often precedes actual market movements. When sentiment is high, markets tend to rise, and when it's low, markets often fall. Imagine a flock of birds suddenly taking flight. This sudden movement can be compared to a shift in market sentiment. You might not know why, but it's a good bet others will follow. This collective behavior can lead to significant market changes. Similarly, when investor sentiment shifts, it can trigger a cascade of buying or selling, driving market trends. This domino effect can amplify market movements. Understanding these sentiments can give you a valuable edge. By staying attuned to the mood of the market, you can make more informed investment decisions and potentially capitalize on emerging trends. Let's bring this to life with a real-world example. Understanding the power of sentiment can be a game changer in the financial world. Remember the dot-com bubble of the late 1990s? It was a time when the internet was just beginning to revolutionize our lives. Euphoria reigned supreme. Everyone and their grandmother was piling into internet stocks, fueled by hype and the promise of unimaginable riches. The excitement was palpable, and it seemed like the sky was the limit. Sentiment indicators were flashing red hot, signaling extreme bullishness. Analysts and experts were warning of an overheated market, but few paid attention. Then the bubble burst. The Nasdaq, heavily weighted with tech stocks, plummeted, wiping out trillions in value. The crash was swift and brutal, leaving many investors in shock. Those who heeded the warning signs of excessive optimism escaped relatively unscathed. They had recognized the dangers of the prevailing sentiment and took steps to protect their investments. This is just one instance of how understanding investor sentiment can be incredibly valuable. By paying attention to the mood of the market and adopting a contrarian stance, best investors make more informed decisions. It's not about predicting the future with absolute certainty, but rather about recognizing potential risks and opportunities based on the prevailing mood of the market. Sentiment can be a powerful tool in navigating the complexities of the financial landscape. Now, let's talk about how to differentiate between bullish and bearish trends using sentiment indicators. When sentiment is bullish, investors are optimistic. They're buying stocks, driving prices higher. Indicators like high consumer confidence, strong corporate earnings, and positive news coverage often accompany this upward momentum. Conversely, bearish sentiment indicates pessimism. Investors are fearful, selling their holdings and pushing prices down. Look for signs like weak economic data, geopolitical uncertainty, and negative media reports. Remember, these are just a few examples. There are numerous sentiment indicators, each with its own strengths and weaknesses. The key is to develop a holistic understanding of the overall sentiment landscape. That's all for today. Until next time, take good care of your finances, navigators, and don't forget to subscribe and share if you found any value.